Well, hello, everyone. Cynthia Tavain with Interactive Brokers, and thank you for joining today's webinar on ROIC, the truth behind the numbers. I'm very pleased to have Sam McBride, an investment analyst with New Constructs, one of the research providers available through the Trader Workstation platform. So I'm very pleased to have Sam with us for today's presentation. So please join me in welcoming Sam while I make him the presenter. So Sam, if you can share your desktop, we'll get underway here today. Thank you for joining us this afternoon, Sam.
All righty. Thank you very much, Cynthia. Let me pull up the slideshow here. Okay, so as Cynthia mentioned, today we're going to be talking about return on invested capital, ROIC, the truth behind the numbers. I'm really excited to talk about this topic here. This is sort of really, if you were going to get to the reason that new constructs exist, it's getting to an accurate calculation of ROIC. That really is sort of the core, mission behind this company is calculating this specific metric in a diligent, comparable, and rigorous manner. And just to give you a little background here, our founder and CEO, David Traynor, he actually worked on Wall Street back during the tech bubble. He was with Credit Suisse back then, and he was working on this same topic at the time, on creating diligent cash flow and ROIC models. And something he sort of discovered at that time was there just wasn't a whole lot of appetite for that level of diligence, especially not then, when no one wanted to hear, this unprofitable tech stock that's trading at, this absurd premium. You shouldn't buy that. No one wanted to hear that back then. And so what he sort of realized was that if he was going to do this work, he needed to do it independently, and in a way that wasn't going to be conflicted by any sort of sell-side relationships. So he founded New Constructs in the early 2000s, and his goal was to do this in a way that would leverage technology and human expertise together. So that's really our core mission, is to take technology to automate a lot of the work going through financial filings, collecting financial statements, digging into the footnotes, and finding the hidden items in there that impact profitability and valuation. And then having expert analysts use those machine annotated filings to go through them really quickly and build really rigorous models of cash flow and valuation. And to give that really does start with getting to ROIC. So let's go through here, talk about the agenda for this session. First thing we're going to talk about is just why ROIC is important, why it's the metric that we've really built our whole models around. And then we're going to talk about, if it's so important, why don't more people use it? We'll talk about the challenges and our methodology of how we calculate ROIC at scale. We'll talk about how you can get access to our research, and then why you really need this level of protection. So getting into part one here, why ROIC is important. I think, this revolves around this sort of simple statement, which is the purpose of capital markets is to allocate capital to its most efficient use. I don't think anyone would argue with that basic. That's what capital markets are for. It's so that people who have capital can find the highest value uses for it. So if that's true, capital should necessarily flow to where it will earn the highest return. And that means that return on invested capital should drive valuations. And evidence here shows that it does. You can see we've got the link here to this white paper, Getting ROIC Right, from Ernst & Young. Really does show the link between ROIC and valuation. And we've got this regression analysis you can see here. So this compares return on invested capital to enterprise value over invested capital, which is sort of a cleaner version of price to book. It shows if you just look at the S&P 500 as a whole, you've got an R squared of 63%. So that means that differences in ROIC explain about 63% of the difference in valuation. So it is a major driver of valuations here. And you can also see here how we calculate ROIC. It's sort of, a deceptively simple calculation, NOPAT over average invested capital. Sounds very straightforward, but as we'll talk about later, it's much more complex than it seems. Now, there's also lots of evidence that top investors really care a lot about ROIC. This is not just something that is, our own thing that we're talking about here. This is something that is very widely recognized as a key driver evaluation, a key measure of corporate performance. So this comes from a survey that was put out by a group called Revell Research. Shows that 77% of buy-side investors say that ROIC is an excellent or very good metric for linking executive pay to performance. It's the number one metric that buy-side investors care about. You can see here, number 2 is the effectiveness of capital allocation strategy, which is a pretty similar idea here. So there's really large evidence that the buy side cares a lot about ROIC. So the question, of course, is if ROIC has this linked to valuation, if it's something that so many people care about, why isn't it more widely used? Why don't you see it, being talked about constantly in the financial press and analysis? So a big part of it is that it's just hard to calculate. As I said, NOPAT over average invested capital sounds simple, but calculating both of those metrics in a rigorous and accurate manner is very, very hard. And there's several reasons why. One is earnings manipulation. This is a pretty widespread phenomenon. There was a survey a couple years ago of corporate CFOs, and they said that they believe 20% of companies intentionally misrepresent their earnings each year, to a level of about 10% roughly. So earnings might be as much as 10% off for 20% of companies, just based off of intentional misrepresentation of earnings by companies. And this is, to be clear, this is not companies that are committing fraud, that are breaking the rules in any way. This is just companies exploiting loopholes in accounting rules in order to boost their earnings. Things like changing discount rates on their pension plans or changing expected return on assets. They can play around with the levels of reserves. There's a lot of different assumptions that management can tweak in order to boost their earnings in any given quarter. There's also a lot of capital that's hidden off the balance sheet. Companies can write down assets in order to get rid of that capital. Operating leases recently brought onto the balance sheet, but there are still ways in terms of, toying with the discount rate that companies can understate that liability. Other comprehensive income, number of other ways that companies can hide capital off of the balance sheet. And that's something where you need to be able to account for all those off-balance sheet sources of capital if you really want to accurately calculate ROIC. Also, changes in accounting rules. A lot of recent changes that are dramatically impacting ROIC. Just talked about the operating leases being brought onto the balance sheet. If you're not accounting for that, it's going to look like invested capital significantly increased, ROIC significantly decreased for companies with large numbers of operating leases. There's also a new revenue recognition rule recently adopted as having a big impact for certain companies. A lot of these things where if you're not paying attention to these accounting rules, ROIC is going to be fluctuating in a way that looks like it's a change in the underlying business, but really it's just a change in the numbers. It doesn't have any real connection to the actual operations of these companies. And then there's also lots of non-recurring items. Companies will have write-downs. They will have restructuring expenses, acquisition integrated costs, lots of things like this that are not really core operating expenses. They are just non-recurring, one-time items that need to be adjusted for if you're really going to get at the core operating profitability of a company. Now, there have been attempts to do this in the past. So you can see this is an article here from CFO Magazine in, if I remember correctly, 1996, titled The Metric Wars. So this is where you had a lot of these different consultants trying to create diligent ROIC-based models for companies. So the most popular and most well-known of these was EVA, Economic Value Added, by Stern Stewart. That's one that is still somewhat in use today. And that is basically ROIC minus the cost of capital times invested capital. So that is an ROIC-based one. You also had a number of other ones, CFROI by Holt, and a half a dozen other of these consultants trying to pitch their ROIC-based models and metrics for companies to adopt. But there was a pretty strong limitation here with that, and you can actually see it in this bottom right panel here in this screenshot. Each consultant comes in and sings the praises of their particular approach or metric and does their level best to take the other guy's product apart. What happened is you had this stiff competition between all these consultants, all trying to pitch their proprietary metrics and integrate each other's ones. And what happened is it became impossible to compare any companies because all these consultants had, different pieces of the market that they were covering. And so if Coke is using EVA and say Pepsi is using CFROI, well, how do you compare those two companies? How do you say, okay, how do I know which company these is more profitable if they're both using different metrics here? And so you saw that start to fade. The enthusiasm for these metrics started to fade in the late 90s as it became harder to compare, and then also as we talked about, like the tech bubble, made it so that investors were not so interested in the fundamentals. They were not so interested in hearing about cash flows. They wanted to buy into the hype of these unprofitable and overvalued tech companies. And so what you see is a lot of these metrics start falling out of use in the late 90s. Coca-Cola and AT&T, who had both used EVA very prominently, abandoned it after 1998. And you can see here all this list of companies that were doing these. Most of these companies, most of these metrics fell out of use around that time. A couple have continued or are still in some sort of use today. So Stern Stewart, we talked about with EVA, their co-founder founded a company called EVA Dimensions. Just got acquired actually by Institutional Shareholder Services, the proxy advisory firm. So you see that still being in use somewhat today. CFROI developed by Holt, that got acquired by Credit Suisse. So there are still some of these being used today, but a large number of them have just dropped off the face of the earth. And part of the reason for that, too, we talked about with the tech bubble rising, the fall of sort of this diligent, fundamental-based research, you get a much higher number of speculators, of non-diligent investors, even among what we think of as, sophisticated investors. If you look at institutional investor categories, there's a great study done back in 2004 looking at the behavior of institutional investors, and it found that, very few are actually what we think of as diligent value investors. Among institutional investors at this time, 61% are classified as quasi-indexers. It means basically they are just owning portfolios that are pretty similar to the index, minor changes, but nothing really substantial. 31% are transient, so they are just, really turning over very rapidly, taking small stakes. They're not trying to do really high conviction, long-term positions. They are just getting in and out, trading more off of noise, really, than off of long-term fundamentals. And so this paper found that only 8% of institutional investors are actually dedicated value investors, taking large stakes, long-term positions in companies that they have a really high conviction in. And so you see, if you got so much of the market being dominated by these sort of not very diligent, not very dedicated participants, the demand for a really rigorous fundamental calculation is just not there at this time. And you see that across the market as well, in terms of just higher levels of speculation, lower levels of diligent fundamental analysis and trading behavior. So you have this holding period for investors declining from 7 years in the mid-1960s until less than 1 year today. Most investors turn over their entire portfolio in a single year. Stock prices are making larger moves in terms of responses to earnings surprises. it really just shows that investors are focusing more on sort of the short-term noise rather than the long-term cash flows of the companies they're investing in. And then you do see, a rise in day trading. Of course, it's become more accessible for retail investors to get into sort of day trading um, and into sort of this very short-term based market here, and that's developed a financial media to grow around that. Mad Money, CNBC, all of these publications, all of these TV outlets that are really orienting themselves towards traders, towards short-term market moves rather than long-term fundamental diligence. And so you can sort of see this idea of, as you have more speculation, as you have shorter holding periods, less conviction, you are sort of propping up unprofitable, overvalued stocks, and you're just sort of reinforcing this momentum-based paradigm rather than a fundamental-based one. And you can just sort of see, what the financial media looks like, what they're pitching towards, not value, not fundamental investment, but hype and speculation. And so what we're always looking for from our perspective is, based off of this speculation, we want to find the companies at either end of the distribution here, companies that have understated cash flows, and because there's not as many people doing the work to identify the real fundamentals, the real cash flows of these companies, they're being undervalued. So that's what we're looking for. And then on the opposite end, companies that are overvalued and have overstated cash flows. So now we'll get into sort of how we dig into this problem and how we calculate ROIC at scale. And that scale is really important because, like we said, with the consultants, the metric wars there, calculating ROIC in a diligent manner has always been possible, but it's been very hard to do across a wide array of companies in a way that makes it comparable. Anyone can dig into the footnotes for any one company and get a really, really rigorous ROIC-based model. But that's a lot of work for a single human to do by themselves. And so what our technology, what our process does is make it possible to do this work at scale. So what we talked about here, the core problem with this is that GAAP earnings, GAAP metrics are exploitable. So the only way to really get a diligent metric is to read the footnotes, the management discussion and analysis to find, the hidden income and charges, the hidden capital there that is based in the footnotes. So you can see just a short list here of the various red flags, the various adjustments we find in the footnotes and MD&A of 10Ks and 10Qs. Hidden expenses and income, unrecorded goodwill. You'll see write-downs hidden in there, minority interest, unrealized gains and losses. Talk about changes in accounting rules can be a big thing. Mid-year acquisitions, that's a big one that we make. If a company has a big acquisition a week before the end of their fiscal year, that's going to be a huge amount of capital on the balance sheet. But if you're trying to calculate their ROIC for the year, you have to make an adjustment for that because obviously they didn't have that capital for most of the year. So we make this adjustment. So we're acknowledging that for their average invested capital throughout the year, that acquisition at the end of the year has only a tiny little impact. So then we get to the key results here. I talked about net operating profit after tax, NOPAT. That's how we adjust from GAAP to NOPAT. Then we've got invested capital. So NOPAT over invested capital is our ROIC here. And then WACC, weighted average cost of capital. So if we're getting into, we talked about EVA, we use economic earnings, which is essentially equivalent to EVA here. And it is ROIC minus WACC times invested capital. And you can see here, if you look at economic earnings, if you look at this ROIC-based measure of profitability versus reported earnings, there's a very wide divergence. Economic earnings have been pretty steadily declining over the past 5 years, whereas GAAP net income has been rising for the past 3 years. So it really is a very different view of profitability, a very different view of the market when you start digging into the fundamentals here, start accounting for the cost of capital. So a good example here of how we use ROIC to value a company. This is an example of a long idea we wrote about a year and a half ago, back in October of 2017. Winmark, they're a sort of small specialty retailer, and you can see they had a really strong increase in ROIC. So their ROIC increased from 13% in 2006 to 44% in 2017. They are a really strong franchisor. They franchise almost all their locations, means they have an incredibly low capital base, lets them earn a very high ROIC. And they're significantly undervalued compared to their peers. So this chart here comes from our original long idea. You can see, just looking at the retail space here, they're the most profitable retailer by far, and they're valued at a discount, based on the trend line here, valued at a discount to their peers based on ROIC and enterprise value to invested capital. And since that long idea was written, they've continued to improve. Their ROIC is up to 53% over the trailing 12 months. We reiterated our call last October. We're continuing to recommend the stock. And you can see here that it has pretty significantly outperformed the S&P 500 since we wrote that idea. It's up 28% versus the S&P up 16%. So that's just one example of how focusing on ROIC and using that as a valuation metric can help lead to long-term stock performance. So you can see here now breaking down our overall rating system, using Winmark again to look at why we think this stock is attractive. So we use 5 metrics as the components of our rating system. 2 of them are based on the quality of earnings. So it's economic versus reported earnings per share. We want companies with rising economic earnings. So you can see here Winmark has that. That's one reason why it's rated attractive. If a company has flat or falling, but still positive economic earnings, they still get an attractive rating. But if, say, the company's earnings are negative and declining, but their reported earnings are rising, that gets into a misleading false positive territory where we're rated unattractive. And then we also rank all the companies under our coverage. We cover about 2,800 companies just by their percentile ranking for ROIC. So Winmark with a 53% ROIC is in the top quintile of all the companies we cover. So it gets a very attractive rating based on its ROIC here. And then again, we go through the different levels of companies are lower ROIC. They rank anywhere from very attractive to very unattractive. And then we have 3 valuation metrics that we look at here. And these, again, they're not exactly based on ROIC, but they do have a significant connection. So free cash flow yield here, it's just free cash flow divided by enterprise value. ROIC obviously matters a lot to that, because if a company is earning a lot of profits without increasing its invested capital much, they're going to be earning a very high ROI or very high free cash flow. Whereas if they're investing a lot, not earning significant profits, that free cash flow is going to be low or negative. So you can see here again, Winmark does very well, 5% free cash flow yield. Price to economic book value is our analysis of the zero growth value of a stock. So economic book value is NOPAT divided by the cost of capital, divided by WACC, and then adding or subtracting any non-operating assets or liabilities. So we want to see what is the valuation of the company compared to its zero growth valuation. So we can see here with Winmark, it's valued at about a 20% premium to its zero growth valuation, basically implying that profits are going to grow by no more than 20% for the remainder of its corporate life. Given the company's track record of growth, we think that's pretty pessimistic. And then we also use market implied growth appreciation period. So this is based off of our dynamic Dcf model, which is our last webinar we did last month talks about that. We use sort of default forecasts and historical average margin assumptions for that to see how many years of growth is required to justify the valuation. So I see right now, based on default assumptions, would market only have to grow for 3 years in order to justify its current valuation of about $171 per share? We think, they're probably going to have a longer growth appreciation period. They're probably going to be able to grow for longer than 3 years. So talking now about how you can beat the market systematically. Now there's really 3 ways we think of to beat the market, and with so much speculation out there, with so much noise, the 3 ways to do it: you can get better data, but that's very difficult. It's very expensive to obtain. As we talked about, going through the notes, going through the MD&A, it's just very time consuming, very expensive. That's why we've created our technology to automate so much of that process. Better analysis. So, if you think about how to analyze companies in a superior way, you're not just trying to out-analyze any one person. You have to, outthink the entire market. So the wisdom of the crowd's idea, even if not everyone in the market is right or accurate, in a large part, you would expect the market to converge on efficient, on accurate valuations. So the only way to beat the market is to have really unique data and analysis. And so we talk about, better data means better models mean better analysis. So we think what we're providing has a unique capability to give people differentiated models and analysis. And then finally, better discipline. With so much turnover, with so many short holding periods, the way to really outperform over the long term is to be disciplined, is to not abandon a position when it turns against you short term, or to constantly be trying to chase performance. And that's part of why we use quantifiable, hard rules-based thresholds for our ratings. Is we don't want to be biased by momentum, by trying to keep up with the herd. We want to make sure we are basing our recommendations and our ratings solely off of the fundamentals, solely off of quantifiable analysis. And that means we're not abandoning a recommendation just because the stock price declines, because sentiment turns against it in the short term. So now we'll talk about, now we've talked about ROIC, how it works, how we calculate it. Talk about how you can get our research. So you can see here is sort of an example of the reports we offer. This is economic earnings versus reported earnings. This chart is in every report that is available. And you can see sort of a fuller breakdown here. With every report, you get sort of this table that shows all of our rating components. You can see again, this economic versus reported earnings, show the adjustments we're making here. And then if you dig deeper, you can see this page of our report. We'll show charts for all of our component ratings. So you can see economic versus reported earnings. You can see ROIC versus WACC. You can see free cash flow yield. You can see price to economic book value, and you can see growth appreciation period. And now you see here, just for a quick example of how to get our research on ABKR, how to access our reports. Cynthia will go into more detail, I believe, on this after I'm done here, but you can sort of see these screenshots that show how to get access to these reports. And I mentioned here, you can see the link to this Ernst & Young paper I mentioned earlier about how ROIC drives valuation. And specifically, it compares our calculation of ROIC to other data providers out there, like Bloomberg and Capital IQ. We've also got a business case study from Harvard Business School that focuses on our robo-analyst and how it disrupts fundamental analysis, how it makes the fundamental analysis process more rigorous and easier. There's also a paper that they're working on right now that's going to show the impact of our adjustments and how they lead to better predictive models for future cash flows. And so I see a question here from Tony. Is an ROIC backward-looking while stocks are driven by future performance? And that's true. It's true. ROIC is a backward-looking metric, but every metric is backward-looking. We can only see the past, so we can only see what's happened. If we had the way to look into the future, I would be much richer than I am right now. I'll say that. No one can see the future. So the best way to predict future performance, we think, is to have an accurate and full understanding of the past and of the present. And so we think companies with high return on invested capital, that shows a lot of things for us in terms of how to anticipate future performance. Companies with high ROICs, that means in the future they should be able to grow more efficiently because they can earn a higher return on future invested capital. We think that shows good management. We think diligent management is a very important thing, and so knowing that management are responsible stewards of capital is very important. And so seeing that high ROIC gives us confidence there as well. Like I said, ROIC, it's not the end all be all. It's not the only thing you need to be looking at to understand a stock's performance and to make your decisions. But we think having that accurate calculation is absolutely vital. And so it's very important to have that roadmap. I see another comment here from Chris. How do you view a company with low and rising ROIC, say from 7 to 12% versus a company with high but falling ROIC? And that's a good question. And I think we do tend to be more optimistic about a company with low and rising ROIC versus high and falling. That's why to go back to that slide here of our rating, you can see, rising ROIC, that drives rising economic earnings. So that's very important to us. Whereas if it's, high and falling, that's going to put it either at this positive, or if it's falling and GAAP earnings are still rising, that's going to put it in the false positive territory. And we're going to be very pessimistic about that. One company that, for instance, that has a high and falling ROIC that we're somewhat skeptical of is Apple. We just think long-term that ROIC is so high. They have an ROIC, last time I checked, about 150%, just really unbelievably profitable company. Long-term, we expect that to regress to the mean. And so that is a case where, we think that high ROIC is unsustainable, that we're more bullish on, say, a company with a low and rising ROIC than a company like that with a high and falling. How did your work capture what expectations are embedded from Nick? So we talk about these sort of metrics over here, the valuation, the price to economic book value. We do think that's a very good measure of the expectations embedded in a valuation, just comparing that to the zero growth value. And then the Dcf model, which let me get out of here and I'll show you guys real quick how our Dcf model works so that we can look at how to capture expectations embedded in the stock price. So I've got a model out here for Northrop Grumman. I'll show you real quickly how we compare sort of our adjustments for no patent invested capital. So you can see these numbers here. You can see for Northrop Grumman last year, their GAAP net income was about $3.2 billion. But after we make our adjustments, we see NOPAT was only about $2.7 billion. So they had a couple of big adjustments that we made to get to this. First is that they had a lot of non-operating pension income. You can see return on plan assets, mark-to-market benefit here. Those really inflated their reported earnings last year. So we make an adjustment for that to get rid of that impact on earnings. And then we also, wrong thing there. And then on the capital side, we're also looking at their sort of reported net assets. We're adding back off-balance sheet operating leases, accumulated write-downs to show that invested capital is actually significantly higher than what the balance sheet suggests. But then to use that to get into our DCF model here. So you can see if we're looking at Northrop Grumman. So if we use sort of default forecast, so you can see here, this revenue growth forecast, this is based off of consensus analyst estimates for the first 3 years, and then sort of long term, we assume it's going to regress to a lower rate. We have our margin assumption here, and again, that's based on historical averages. The tax rate, based on their average as well. So we can see, sort of based on this dynamic model here, how far out you need to go to get to their valuation, and what kind of growth is embedded there. And we can also see ROIC that's embedded. So Northrop Grumman had about a 7% ROIC last year. So we can see, they're projected to justify their valuation, which they had. Look at this again. They had a 9-year growth appreciation period here in their forecast to get to their stock price of $325. So we can look at that and say, okay, to justify that valuation, they have to grow NOPAT by 7% compounded annually for 9 years. They have to achieve an ROIC of about 10%. So that's how we use our tools to capture this this sort of expectations implied by the stock price. All right, so let's go back here into the slideshow, and we will finish up here with the appendix. So I talked about how to get access to our research. So just to sort of talk about why we think it's increasingly important to have diligent research. Part of it is the complexity. The length of filings continues to grow. A 10K at this point is about the length of an average novel. So it is just incredibly difficult for any individual to try to do this work at scale. And you can see accounting rules constantly changing, as we talked about. The SEC, the FASB, just constantly updating and changing the rules. So you need to be on top of that as well in order to understand the cash flows of these companies. And so we've got, who has time to go through that? You can't. That's why you need technology. That's why you need the machine learning, the natural language processing technology we use to automate so much of this process so that we can create these models at scale. So here's just sort of a quick list of some of the clients we work with here. You can see we've got to work with institutions, with advisors, retail investors, consultants. You can see sort of a basic flow chart here of how our technology works, how the filings would go from the SEC filings that go into our extraction system, what we call our auto parser. So it goes into this database where we take all of these line items and we put them into various buckets that have been classified in our system. We have thousands of these buckets that we use to classify unique data points so that our system can automatically calculate a lot of these numbers and can then flag for analysts these notes in the financial statement so they can then go through and determine what's the appropriate bucket to place all these other data points in. And then that all that data gets fed into our calculation engine, which then creates our models that I showed you there for Northrop Grumman, and that all gets put into our user interface on the web where you can see the models, you can see the ratings, all of these tools that we provide. Here again is sort of a quick note on how our free cash flow works. So this is again NOPAT minus the change in invested capital. This differs very significantly from how many other companies calculate free cash flow. A lot of times they'll use cash flow from operations minus capital expenditure. But we think that misses a lot of stuff. That misses, acquisition costs. That misses increases in operating leases. Cash flow from operations can be distorted by non-operating or one-time items. So we think you really need to go deeper than just using the cash flow statement in order to get an accurate calculation of recurring free cash flow. Again, you can see not only are filings getting longer, but the material items, the adjustments we find in these filings are getting larger. Large number of write-downs, hidden non-operating items here. We talked about return on plan asset assumptions. This is a really big issue that not a lot of people pay attention to. When companies have pension plans, in order to smooth out the impact from their pension plans on the income statement, they don't use the actual returns. They use expected returns. And companies have a lot of leeway in how they estimate their expected return. So you can see, average is somewhere around 6.5%, but companies can go all the way up to 9% plus on their expected returns, and that's one way they can distort the income statement. Again, we talked about at the beginning how we're 100% unconflicted. We don't have trading, corporate banking ties. We're not being paid by any of the companies we cover. There's no conflicts of interest here that are impacting our ratings or our methodology. All right. So let's get back here into the model. Other questions. Link to the white paper, so that will be in the slides. That will, I believe the slides will be published after this, and in the slides there are hyperlinks, so you can get access to that white paper. Another question here. How many companies are using ROIC as part of their performance metrics? So as far as you know, right now about 30% of companies are using some form of return on invested capital or other capital efficiency metrics in order to determine executive pay or just measure overall performance. We actually have a model portfolio, our executive compensation linked to ROIC model portfolio, that tracks companies that get our very attractive rating and link executive compensation to ROIC. So that's one way we try to account for that, to look at not just companies with good fundamentals, but also quality corporate governance. So I don't see any other questions here.
Well, at this point, Sam, what I'd like to do is take over the controls and show folks how you can access that or the new constructs information directly from the Trader Workstation platform. While I am showing you this, I do want to remind everyone that the questions panel is located in the control panel on the right-hand side of your screen. If you've got a question, go ahead and add that now before we do conclude today's event. But with that, let me go ahead and make me the presenter. So now you should be able to see my website is now available or showing on the on your screens here. Now, to access new constructs information, notice that we'll simply go to the pricing menu, and underneath research and news, you can find the information here. Now, I'll jump over to this page, and you'll see that it does include several different jump links at the top. Now, to save time here today, I did do a search on new constructs, and notice how this will appear on that page. You'll see the information that's available, and I do want to note that we do provide a free 30-day trial period for you to try the research tools that New Constructs does provide. Now, notice on this page here, there's a Learn More button, and also it is showing you a third-party tool. Now, I do want to mention before we jump into that Learn More button, notice here, I'm going to bring the Trader Workstation up. This is IB's core trading platform. Now notice that I'm actually looking at the mosaic screen, and as Sam showed you in the screenshots included in his presentation, you'll find underneath the new window button, go down to Analyst Research, and here you can find the new constructs reports that are available, and Sam did show you some of those report pages in today's presentation. You'll also find some additional information. Notice down here, I'm going to scroll down, and there is a institutional version that does provide you with that third-party tool. Now, this is all available from the Mosaic interface. Notice here, I'll go into Analyst Research, and I'm going to launch, let's go back up on top, to the new constructs research. You'll see that it does open up a separate window within the Trader Workstation that includes all the latest reports that are available. But also notice that there is a search field that's included. If you're looking for something in particular, a stock or an ETF, notice here I'm simply going to add a ticker symbol and then click Tab or Enter, and you will have to identify the underlying. But once you do, notice how it opens up a separate page here where you can go in and actually launch that report. And that launched over on my secondary screen, so I'm going to bring this up over here. Let's put this into full page, and I'm going to reduce it so that we can see each of the pages that are available in that report. Notice these sample reports are easily accessed directly through the Trader Workstation platform, so I did want to point that out here. Now, also, if we do get back into our website, I'm going to go back into the Research and News menu underneath the pricing selection. Notice here that Learn More session will actually take you to a separate page where you can view some of those sample reports and also visit the New Constructs website. So I did want to point that out. Notice if we click through here, you could drill down to any of these stock, ETF, or mutual fund sample reports that are available, or simply move out to the website. Now, if you do subscribe to the New Constructs institutional platform, it will give you access to that third-party tool that Sam has been showing you here this afternoon. So I did want to mention that. And by the way, also Mark had asked about getting a copy of that Ernst & Young report. Notice here, I'm going to bring up, and let me bring up, this is actually from, and looks like I'm bringing up everything in full screen access. What I did want to show you, let me go back into the webinar notes. And here's that slide that Sam did include in his notes. You'll all be getting access to this later on this afternoon when I do send out a direct link to today's recorded playback. These notes will be available. And notice these links are clickable. So mark page 35, you can find access to that exact report. So did want to mention that as well. Now, while I've been talking to you, I'm not sure if there are any additional questions that have come in. So let me bring Sam back on. Any last minute thoughts? I'm not seeing any additional questions, Sam. How about you?
No, I don't see any other questions now.
Okay. Well, with that, then, what I am going to do is conclude today's session. I want to thank all of you for your participation with us here this afternoon. And let me actually bring up our website as well, because I do want you to see, if you happen to be listening to this as a recording, that underneath the education menu, you'll find a webinar section. And from here, you can go into the upcoming webinars. Notice here we do have a link, but our recorded webinars will also be listed, and today's will be listed on this page here. Notice that you can find right up at the top, the recording link will be provided, and you'll also see the notes link. Now, Mark, this is what you're going to be looking for as well, that will give you access to any of our webinar notes. Now, notice here, wait a minute. I've actually got a separate window open up there, so I'm going to close that out. But I did want to show those of you who are listening to this as a recorded playback, where you'll also be able to access today's information, as well as we have a wealth of items that are included. If you do go into that sponsor category, notice here, I'm going to check the sponsor and scroll down to New Constructs, where you can find let me see, I'll have to scroll back here sorry about this, everyone. But if you do want to view any of that, notice that simply by applying this selection here, I may have to refresh the page. This will actually bring you up a filtered list of webinars that have been provided by New Constructs. So I did want you to be aware of that. But that is going to conclude our session here today. I want to thank all of you for participating in today's webinar and remind you that we are going to be um, sending out direct links to today's recorded playback soon after the session ends. So if you do want access to any of the concepts that Sam has been discussing, simply watch your inbox later on this afternoon. I do see one more question. Did you want to address that, Sam?
Yeah, I can answer that question.
Okay.
So we got
Nick,
another.
you got it in just in time.
Yeah, so we've got another question from Nick here asking about a small software company where the ROIC may be poor while building the company, but as they scale, it improved dramatically. And it's true. That's true that for some of these early stage companies, I do think it's true that our research might not be as useful for an early stage company where you're looking at negative profitability, negative ROIC at the beginning. And so that is a case where maybe you don't want to use ROIC alone in that case, and it's you have to dig a little deeper, and that's where I think our tools for looking at the expectations implied by the valuation are useful, because you can't necessarily look at just the profitability at that point, but you can say, okay, if we think it can achieve this market size, if we can get, this, X percentage of its total addressable market over the next 10 years, and it can achieve margins comparable to, certain competitors in this market. And that's where it's useful to have, say, ROIC and margins available for the more established, mature companies in the industry. So if you're looking at a small software company, you say, okay, let's say it can get the margins and ROIC of Oracle over the next 10 years, and it can achieve this level of scale. And you can then compare that to the valuation using our DCF tool and say, okay, is this a realistic valuation or not? So even though ROIC may not be useful for understanding the operations of that company in the short term, I think having the widespread availability for the peers, having an average to look at, and being able to look at it through the DCF tool does create a lot of value and make it easier to understand the long-term prospects for the company.
Well, Sam McBride with New Constructs, thank you so much. Terrific presentation here this afternoon. Also want to thank all of you for joining us here today. This is going to conclude our webinar. So thanks, everyone. Have a great rest of your day. And do watch your inbox for the recording link and today's webinar notes. Have a great rest of your day, everyone, and thank you.